Joining in on the show is Mezli Bushnarmat, consulting editor ET Now, as well as Wwatch, economist at ING Vesya Bank. Great to have you both on the show. Mezli, I'm just going to start off with you. We're talking about growth of close to 1.4% for IIP, and given that we've seen contraction, I think since the September quarter, this number is going to be viewed at as pretty positively.
Well, yes, Avan, but I think unfortunately or fortunately for us, till May this year, I think whatever the numbers are, I think markets are just going to shrug them off unless they're very nasty surprises. And positive surprises, unfortunately, we can't really hope too much for. And I don't anticipate a negative surprise either. So broadly, as long as the numbers are, within those anemic 0.1 to 1 or percent, I don't think anything really going to change dramatically overnight. But yes, if we get a nasty surprise one way or the other, definitely markets will react. But I think till otherwise, it will be, more or less status quo, because everybody's waiting to see what happens post-May. So I don't think one should attach too much importance to these numbers. Yes, they're important, but as I said, unless there's something very drastic, either way, I don't think one should waste too much time and effort on them.
Upasna, some numbers that will come out in around 20 minutes time from now, the trade data, and generally, seasonally exports tend to be strong in March. How do you expect these numbers to be?
Yes, I am looking at a stronger export number. However, on a Y-on-Y basis, there is a likelihood that it continues to remain slightly on the contractionary phase. Nevertheless, overall, I think given that imports are still not picking up at all, I am looking at a significantly improved number on the trade deficit front. My number is probably a little below the consensus, but it is around 5 billion deficit, $5 billion.
Upasna, if that is your number for the trade deficit, what would your number be for the CAD? Would that also be less than what the government and other observers have been generally projecting?
Yes. At the moment, what I believe is that the March quarter current account should be a surplus number. It should deliver a surplus. And it is not surprising because the kind of appreciation in rupee that we have seen, it does corroborate with that as well. So overall, I think the sharp narrowing of the trade deficit numbers will definitely help in delivering a positive current account number.
Except for the fact that actually if we look at the rupee has been strengthening and recovery worldwide has not been that marked as to make up for the strengthening of the rupee. So exports, you would normally expect exports to slow down, and we have seen signs of exports slowing down in the month of February. So can you explain why you're so positive as far as the trade deficit and the CAD numbers for the year as a whole are concerned?
No, see, you already have the January and the February numbers. You've already seen a marked improvement in the trade numbers there. The March number in itself, seasonally, like you mentioned earlier, is a positive number. It is a month in which you tend to see some amount of improvement. The year end tends to bring in some kind of a seasonality, which tends to show improved exports. So we do expect that to pan out into a relatively better number. And that taken together for the previous 2 months trade numbers, I think overall we're getting an extremely narrow sub-30 trade number for the quarter. Trade deficit number for the quarter.
Okay, a sub-30 number is really a very low number given the CADs that we've had in the past. But do you think that's sustainable for the next financial year, the current financial year rather, 14-15? And is it really good for a developing country to have such a low CAD? Because after all, a developing country, in fact, would like to draw the resources from the rest of the world. So is that a really happy sign or is it an unhappy sign?
In the current context, in the short term, I would say it has been a good development. But one, in terms of sustainability of these levels, I do not see this sustained. Largely on account of two factors, that of course export growth will not be as sharp as what we've seen during the July to January months. I do not expect that kind of a sharp rebound in export. It will be showing, of course, improvement, but not very sharp improvements. At the same time, I do expect some kind of a stability in economic activity to result in a pickup in imports. There are talks about gold imports, the curbs on the gold imports being eased after a while, and that in itself will start putting pressure on overall imports. So I think in the next 1 or 2 quarters, we may continue to see more or less benign numbers. But as we move towards the second half of FY15, I think the pressure on CAD will again begin to build up.
We just heard the RBI Governor Raghuram Rajan telling the Fed to kind of take some sense of what's happening or the spillover effects of the Fed's action on emerging markets. Do you think the Fed isn't inclined to listen, or do you think it's just water off a duck's back?
If you were to go back to the May 2013 time when Bernanke had actually made a statement which did bring about a lot of chaos across the world, across the emerging markets, I think post that they have definitely improved in their communication. They have tried to provide a forward guidance which does provide some kind of stability in the global financial markets. So to that extent, they have learnt it the harder way, that it is not going to be easy for them to withdraw the excess accommodative monetary policy that they have introduced over the past couple of years. So definitely, I think they have been keeping cognizant of that fact, and they are going to be withdrawing it they are maintaining a very gradual pace, and they will continue to maintain a gradual pace of withdrawal. So I think somewhere at the moment Fed will continue to withdraw its accommodative monetary policy only in a very gradual phase, and to an extent they are accounting for the impact that it could have on the emerging markets.
If I can move now from the external to the internal, what kind of numbers are you hoping to see in the IIP? And does it really matter either way? Or is the market really fixated on the elections and everything else that happens is secondary?
One, I don't think markets would be really looking at the IIP numbers too much, because somewhere it has already been priced in that the near-term economic activity is not going to show any signs of improvement really. We are in that very sluggish mode of recovery at the moment, and I don't think markets would be paying too much heed to the numbers that come today. But of course, IIP tends to be an extremely volatile number. So that's another reason I think markets should not really pay too much attention. I am expecting a slight contraction in the IIP number. If you recall, the export growth has not been very good in the month of February. At the same time, we haven't seen auto sales or anything improve significantly. So I don't really see too much of improvement on the IIP number. At best, it could be a flattish number, but I don't see a significant improvement in an IIP number. So I am on the other side of the market consensus. But having said that, I don't think markets should be reacting too much. They would be more focused on other factors, other parameters which are due next week. I think CPI and the WPI numbers would be of more importance as we go ahead into the week.